Hey, everybody. Welcome back to Chipstock Investor. I'm Kasey.
And I'm Nick, and we are talking about mindset in the midst of a bear market, right?
Exactly. We're talking about something that you probably will not see on most stock charts or on earnings calls, your mindsets. Not just the technicals, not the macros, not even the secular growth trends. We're going to be talking about the way your brain works, the way it tries to sabotage your investing, and more importantly, how to catch these mindset traps and shut it down before it costs you. In the span of about 3 months, almost four now, we have run through pretty much the entire gamut of emotions when it comes to investing. There was the crowd that believed that the new presidency in the United States would usher in a new get-rich-quick period for stocks and other risk assets at the end of 2024 and early 2025. And now we have the problem of tariffs seemingly going to end the current world order, and it's time to sell stocks, bury gold, and guns in the backyard, right?
Yeah, I guess so. We're talking about this because if you're a long-term investor, there's, like you said, Kasey, no knowledge of secular growth trends, no knowledge of industries, no knowledge of valuation metrics. Whatever you think you know is going to happen probably is not going to be what actually happens. It's not going to prepare you. But one thing that you can prepare yourself with is exactly what you said, your mindset. And I think before we delve into some of these mindset tactics that we've been talking with our semi-insiders about in the last month or two, actually really since the end of 2024, when we took some heat for telling everybody we were raising just a wee bit of cash in our portfolio, before we get into some of those combating negative mindset self-help bits, I think we probably first need to acknowledge the end of the bull market, the NVIDIA and semiconductor driven bull market of 2023 and 2024. We're certainly not ripping to shreds this thesis that data and semiconductors and digital infrastructure supply chains are the end. That's still very much going to be a secular growth trend. But at this point, things have definitely changed. And so we're now in this mode of looking for what's next, what's going to pull us out of the current tailspin, because whatever does pull us out of this tailspin, we think it's probably going to be a bit different than the last 2 years. Maybe not the shortest bull market ever. Maybe the shortest bull market ever was 2020.
In a recent episode of CSI Live, we played a little game, Name That Market. And we're going to show you a couple slides from some market meltdowns that happened in the past. And we'll talk a little bit about how this affects us right now, how it affects our mindset right now.
Yeah, here's the game. We've hidden the timeline on this chart. Kasey, what time period is this displaying? This is a big drawdown in the S&P 500 and the NASDAQ as measured by SPY and QQQ.
Mm-hmm. Somewhere in the 2000s.
Yes, we were both alive at this time, alive and maybe not so well, as this is 2020. Here's the reveal. And the reason we're showing you this is we think that the correction that we're now in the midst of could play out somewhat similarly. Obviously, it's not a pandemic that's causing this, but the end result of this 30, 40% ultimate drawdown in the S&P and the NASDAQ indices was another very brief bull market, but supply chain disruption was very much part of the ongoing concern that businesses had to sort out. Hopefully we don't get another brief 1-year bull market followed by something like the Fed hiking interest rates and undoing progress. But at this point, we're in the midst of this and we're thinking this is more of an event driven bear market that we're now in. Maybe not something that's completely systemic, something that's not fundamentally wrong with the economy that's causing this, but really just a shock to the economic system driven by this event of tariffs. And so that's why we're kind of looking for not necessarily the bottom. We're certainly not trying to time the bottom, but we're continuing to invest in quality stocks, businesses that participate in the secular growth trends that we think will continue beyond this market shock, and looking for which of those will emerge from this in some sort of new leadership position. This is exactly the playbook that we deployed in 2022 that ultimately led to us having NVIDIA as our largest position and starting the chipstock investor channel in October 2022. That's where we're at right now. Let's maybe get to the discussion on mindset.
Now, if you think this was a super fun game and you want to play it all the time, check out Semiconductor Insider membership. Link below. We have live Q&As every single week, educational seminars, published show notes, and a great community of like-minded investors. And we're having a market meltdown sale. Check it out in the link below. When talking about investment mindset, we're going to be focusing on just 3 biases that we have seen especially prominent in the last few months. There's a lot of biases that can happen in investment, and biases result from taking in data and processing it maybe incorrectly and making poor investment decisions because of it. We'll kick off with the first one, projecting. This is when you assume that other people think, act, or feel the same way that you do, and it can also be known as maybe a false consensus effect.
Ooh, pulling out some psychology terminology there, huh? Yeah, we see this one a lot, especially when it comes to product-based investing, which includes software businesses. Most software is an end market product. So maybe you love a product, or maybe you hate a product and you can't stand it, you don't want to use it, and you think that literally everybody else feels the same way about it as you. And you project that feeling onto everybody else and you make an investment decision based on that. That's a bias that can get you in big trouble. But you have to remember everybody has different preferences, different opinions, different pain points, and so on and so forth. We're not all the same. And that's totally okay. It doesn't mean a stock or a business isn't a buy. It doesn't mean it's time to sell. It means just what it is.
So what can you do about this consensus effect or bias? You have to zoom out. Ask yourself, what does the broader market think? What is the competitive advantage for this company? Zooming out helps you combat this bias. The second bias is confirmation bias. And this one is very sneaky and it's very dangerous in the digital age that we live in right now.
Yeah. And even if you're a consumer of traditional media, not just social media, this one's really rough because the algorithms probably know you and your preferences better than you do. And they're always working to try to make money off of what it thinks you're going to click on, what's going to lure you in. This confirmation bias, much like it sounds, is this tendency to seek out information that supports something that you believe or that you think to be true, whether or not that's actually the case.
We see this play out when folks build an investment thesis and then go looking for articles, posts, or videos that back up that investment thesis. In fact, they'll ignore some of the bearish arguments and red flags because it doesn't fit their confirmation bias, their own assumptions. But here's the thing. If your investment cannot survive contact with the bear thesis, it's not a very good thesis.
A well-rounded investment approach doesn't ignore risks. You have to acknowledge them and work them into your assumption when buying a stock, especially if it's one that you ideally would like to hold for the indefinite future. Doesn't mean it's a forever stock. As long as the thesis matches and lines up, you have more green check marks than you do red X's next to the points that you have in your investment framework. But you have to acknowledge that there's going to be some red X's there in the thesis that you need to be aware of as you monitor and continue to learn about the business that you have an equity stake in.
The third destructive mindset that can really affect you as an investor is actually twofold. It's overconfidence and recency bias. Overconfidence is exactly what it sounds like. You think you've got it all figured out. You've made a few good calls, made money, and now you're convinced that you're Warren Buffett.
Or Peter Lynch or whoever. The overconfidence comes in when you make an investment and you start to make a little bit of money and think, wow, I've got this all figured out. And that works in tandem with that recency bias, right?
Exactly. Recency bias, your brain starts telling you that recent events are the norm. The market's been down for a month. Well, clearly it's going to keep going down forever. Or stocks went up 3 days in a row. They can only go up from here. That's recency bias. Both of those scenarios feel true because it's the most recent event.
And these two things kind of interact with each other. And you're going to hear, especially right now, at least as of this recording, the established trend is to the downside. And you're going to hear a chorus of people constantly calling for more and more downside. Fortunately, fear and greed are two sides of the same coin. The trend will eventually change. So don't let recency bias fuel your overconfidence that you have it all figured out. And especially if you're a long-term investor, there is benefit in skewing slightly towards optimistic. I'm not talking about being a permabull or anything, but skewing towards cautious optimism most of the time, radical moderation, as we like to call it here, does win out over the long term. Because by and large, what you're betting on when you go long investing in a business is you're betting on human beings doing what human beings do best, building things, constructing, figuring out how to make money, how to make a living. So as bad as things may seem right now, the whole world is incentivized to ultimately figure this thing out and move forward and get back to doing just that, making money. So don't let recency bias and overconfidence that you think the world is coming to an end, you need to sell all your stocks, make you do just that, sell all your stocks. This is exactly the playbook that we deployed in 2022, in 2020, 2018, the start of the trade war and tariffs and the first Fed rate hike cycle, 2016, 2011, 2008, so on and so forth. We skewed towards cautiously optimistic and deployed small amounts of cash throughout the downturns into quality businesses we thought would come out the other side of this, not unscathed, but reemergent, stronger than they were before, and ready to get back to making money, making profit for their shareholders. That process is not going to change for however long this downturn continues.
The reason why we're sticking with investing, we're trusting our process, is because of this chart right here. This is the same two lines, the S&P 500 and QQQ, but over the course of 20 years. Now, we've been invested for basically this entire time, and we're still pretty young, but this is why you stay invested. If you zoom out a bit, you can see in the long term, you have those great gains. So the key takeaway from this video is what?
Well, the longer you're in it, the better things get when you're invested. Investing ages really well. Also, if you're a newer investor, maybe you're not so far along in your journey of putting money to work, especially during times right now, figure out how to tighten your belt and be a net saver as frequently as you possibly can. If not every month, putting money into your account, try to do so quarterly or as frequently as you possibly can. Keep adding to the account. Don't let the recent market action scare you away from this game, because especially when it feels worse to do so, investing actually has the most possible upside to it. Yeah, stick with it, everybody. Join us over on Semi Insider for more talks like this, live Q&A, and all of our research, the complete body of work that we do here between the two of us.
Thanks everybody for watching this episode. We'll see you again very soon here at Chipstock Investor.